In last week's video, I introduced you to the covered call and showed you step by step how to sell them in your account. I also provided data to show how selling covered calls is mathematically proven to increase your overall returns and reduce your account's volatility. Now, in this video, I'm going to show you my real money account and current covered call positions that I have on and give you my overall thought process with all of this. Alright guys, this is my real brokerage account that I have with TD Ameritrade. This is the Thinkorswim trading platform, and if you're not used to looking at this, I realize that it can kind of be painful on the eyes, but I promise I will show you exactly where to look. Right now, I have covered call positions on PayPal, Micron, Disney, and GoPro. So let's begin with PayPal. I currently own 300 shares of PayPal, and I have 3 call options written against my 300 shares. Because I have 300 shares and 3 call option contracts, these are covered calls. This is the 130 strike price in the March 18th expiration cycle. When I originally sold these call options, I collected 31 cents of premium times the 100 shares per contract gives me $31 of premium. I did this on 3 contracts, so overall I collected $93 of premium. The share price on PayPal has increased a little bit, which is the wrong direction for these short call options. So as a result, the current trading price of this call option is increased to $56, which means that I currently have some paper losses on this position. Nevertheless, as long as PayPal remains below 130 at expiration, I will be able to keep all 300 shares and the premium that I originally collected. Same sort of situation down here with Micron. I've got 300 shares. I've got 2 call options at the 105 strike and 1 at the 100 strike. Micron has been performing really well for me. It's one of the only stocks that's held up well over the past couple months. So if Micron were to go above $100 per share, I would be happy to sell 100 of these 300 shares in order to liquidate 100 of these shares to generate capital to then push into other companies that have stock prices that have been severely punished. I collected $134 per contract on 2 contracts for this option and $165 on this option. Moving on down to Disney, got 100 shares, 1 call option written against it at the 162.5 strike price. I collected $94 of premium on this one. And finally, if we go down to GoPro, you can see I've got 700 shares, 7 short call options, otherwise known as covered call options, at the $10 strike price, and the share price is currently trading at $8.54. So that's it for my current call option positions, and now I want to get into some other important things to keep in mind. When you sell covered calls, remember that the premium that you collect, or the money that you collect when you sell those call options, is short-term capital gains. This means that it's taxed at your ordinary tax rate. So if you're at the 22% federal income tax bracket, you will pay income taxes to the federal government at 22% plus any state taxes and local taxes that you may owe. This is different than when you sell shares of stock that you've held for over 1 year. If this is the case, you get taxed at the long-term capital gains rate. This is only 15% for most people, which is definitely less in taxes than you would if you're at the short-term capital gains rate, which is your ordinary income tax rate. It is important to understand this when you begin selling options in a brokerage account. Along the same lines, if you sell covered calls on companies that you've held for less than 1 year, if those shares then get assigned, you will be forced to pay taxes on those capital gains at your short-term capital gains rate, which again is your ordinary income tax rate. That being said, there are creative ways to avoid paying short-term capital gains tax on stock positions that may have to get assigned. In order to better explain how to do this, I am going to show you an example. This is the option chain pulled up for PayPal, and again, I know there's a ton to look at here, but just follow my mouse and I'll show you exactly what you need to pay attention to. Let's say in this hypothetical example, you sold a covered call at the $109 strike price. Currently, this option is trading for approximately $4.15. Because I sold to open this covered call position, if I want to close this position to avoid getting assigned on, I would have to buy back this option position for about $430, $420 if I get a slightly better price on my fill. Then what I can do after I buy to close that is I can sell to open a new covered call at a new strike price and expiration. Here I've got the April 14th, 2022 expiration cycle pulled up, which is about 1.5 months in the future. Let's say I want to sell at the $115 strike price. If I was to do this, I would collect approximately $570 of premium. Because I'm collecting more premium on the new option that I'm selling, I'm going to collect an overall credit. Again, this summarizes what's going on here. I'm buying to close this call option and then selling to open the new one with the new expiration at the $115 strike price. So to summarize what's going on here, I'm avoiding assignment and potentially avoiding having to pay short-term capital gains. I'm then increasing my strike price, which is a good thing. I'm extending my expiration 1.5 months, and I'm able to do all of this while still putting additional money in my pocket, approximately $155. This whole process is called rolling an option. I'm closing one option position and then reopening a new option position at a new expiration and perhaps a new strike price. Rolling is something that is incredibly useful, especially when you want to avoid assignment. I do this all the time with my options, and it's definitely something you need to be aware of if you're going to be using some strategy like this. Some brokers are so convenient that they actually have a roll button that you can then click on and then just enter in the new strike and expiration that you want to use. Other brokers like TD Ameritrade, you can just click on what you want to do, or they also have this rolling feature as well. The last thing that I wanted to cover in this video is addressing a concept I brought up in last week's video where I talked about at-the-money calls and 30 delta calls and how this applies in the real world with a real account. All that an at-the-money call is simply selling a call option with the same strike price or very close to the same strike price as the current share price. In this case with PayPal, an at-the-money call option would be the $110 strike price. That's basically the same as the current trading share price. Realistically, in most situations, you're not going to be selling at the money. You're going to be selling somewhere out of the money. In other words, the strike price is going to be higher than the current share price. The question becomes, how far away from the money do you want to sell your covered call option? For this, we can look at delta. This is the column here, and if we scroll down, we can see that 30 delta would be somewhere between 120 and 125. There's not an exact 30 delta call option with PayPal in this expiration cycle. In simple terms, all we're really talking about here with delta is how far away from the current share price I'm selling that covered call option. The further and further away from the current share price, the lower this delta value becomes. When selling covered calls on your positions, it's important to ask what that position is serving in your portfolio. Did you buy that position just to sell calls on it? Or if you're trading the wheel strategy, is that your overall plan? If you're doing that and you don't really want to hold this stock for the long term, or you don't mind if it gets assigned, you could totally sell call options with higher delta values like 35 or 40. That's definitely in play. However, for PayPal in my overall portfolio, the only reason why I'm selling covered calls is to slightly reduce my adjusted cost basis, therefore decreasing my overall risk, and hopefully generating slightly larger returns over the long term. However, the primary factor in me being successful in my PayPal position is the overall share price. In other words, I'm not trying to get these shares assigned. I want to hold PayPal for the long term. Since PayPal has recently come down significantly in price, I'm not going to be too aggressive in selling my calls. I'm probably going to be hanging out here somewhere in like the 7 to 10, maybe 15 delta range. In the end, there's no hard and fast right or wrong way to sell covered calls. You just have to use common sense and try to figure out overall what you're trying to get accomplished. Starting sometime over the next couple weeks, I'm going to be putting out an options series, so stay tuned for that. For those of you who struggle to understand the way some other people teach options, I think you're going to get a ton of value from this video. I'm not just going to throw you with a bunch of definitions and terms. I'm going to help you guys really understand what's going on. So whether you're a total beginner with options, or if you're actually quite advanced, no matter where you're at, guys, I think you're gonna get a ton of value from this series. With that said, if you've made it this far in the video, thank you so much for watching. Don't forget to like the video, comment down below, and consider subscribing. Until that next one, peace.